Markets feeling the push and pull of a lot of different factors. Ken Griffin's certainly concerned about how investors are seemingly viewing gold as a safer asset than the US dollar. Is this a concern you share?
Not fully, because I think if you look at the dollar there's always sort of a stock versus a flow that I think you have to approach for any asset class. I would, keep the dollar and Forex in that where, coming into this year, positioning in US dollars and that currency relative to most of the world was quite strong. So some of it, I think, is sort of a hedge against some of the geopolitical risk premium that is now put on the United States, but also maybe just taking a little bit of a step away from everything U.S. And we can see that reflected in equity markets. You can see that reflected in some fixed income markets. So I don't think it's this Armageddon-like shift away from the dollar, but I do think that there is something to be said about some of the trends maybe that are being initiated or put into place now, whether it's questions around things like Fed independence or it's questions around, corporate earnings in the U.S. and how strong they're going to be for the bulk of the U.S., not just a slim number of companies in the tech space or anything that's being touched by AI. So I do think that it's valid, but I also think that the correction that we've seen in the dollar, I wouldn't extrapolate it into it's going to be this sort of epic turnaround in the currency. I think there needs to be a lot more that happens until that becomes the case.
What do you make, though, of the run-up in gold, which go back a few years, you couldn't touch it for a long time and nobody wanted to touch it, but yet it's been pretty substantial this year.
It's always interesting because, gold as this asset class, it's hard to compare it to a lot of things because, it doesn't earn anything. It's really just the price moves that's going to, dictate everything. So it's really just an indicator of sentiment is how we look at it. So right. I like to use it as a sentiment gauge, but it's interesting too because it's not like it's happened, the surge that we've seen this year, it hasn't happened in conjunction with an overly defensive trade in the U.S. equity market. If you look at the traditional defensives.
How do you explain that?
Exactly. So I do think that it could be currency related where there is a little bit of a fear, like Ken was mentioning, about the dollar maybe losing some of that status as its haven. But there's so much data to back up that that's not the case. The BIS just released its triennial survey of Forex and looking at the share that the dollar has in the world of everything from foreign transactions, cross-border transactions, all the way to central bank holdings and, global debt, global equity. The dollar is still, top dog. So I think that that's where the stock versus flow comes into it and where you could see something like gold, from the sentiment perspective, clearly it's getting caught up in such a strong momentum trade, and momentum is a powerful factor. Very powerful in equity markets, very powerful in other asset classes.
One last question on gold before we move to another big momentum trade this year. Are you suggesting investors buy gold in some form or another?
We don't have formal calls on gold itself. Okay. I think
you can make one right now if you want.
From the average investor's perspective, and it's tough because we've got millions of clients. So to give some sort of blanket recommendation for a client is always a hard thing to do.
But we're
especially
talking
for
about
us.
metals and mining and different things more broadly than we have in a long time.
Yeah, for sure. I think that certainly diversification in other asset classes, and I think this also speaks to me, I backed this up several years where you look at something like fixed income has become now a very serious asset class for a lot of people who are looking for yield.
Right.
Who, if you've been in the market for a long time, 20 plus years, there was a long period where you couldn't get any yield. For a younger investor who is just entering markets in the past several years, you're stepping into an environment where there are so many more options and so many more opportunities. I think that something like gold fits into that in terms of what is your set of options that exists.
Right.
So for a younger investor, I think it's, somebody who's newer to this, I think it's a great world to look at where you can see that there are all these options. But even for somebody who's been in markets for a long time, investing for a while, you're now starting to see that there are other things that work, not just a U.S. equity story, for example.
You know what really works?
Is it AI, Carol?
Maybe.
Well, it's worked so far, and that's the question and really where we want to go to with Kevin. I saw you post earlier today this graphic from the Financial Times.
He was actually... Carol, come over and look at this.
I said, come look at this, and then I sent it to the whole team, and then I retweeted it. Not that I know.
Here we are.
Here we are. And I said, we got to get Kevin on the program. But it's basically, it's this, if you were to take a whiteboard, and OpenAI is at the center of the whiteboard, you connect every company investment, a relationship with OpenAI, and the list is long. Microsoft, Oracle, NVIDIA, CoreWeave, Anthropic, Meta, Amazon, Google, Broadcom, and more. And it talks about the interconnected relationships, investing, customer, partner. Mm-hmm. Some of these are multiple relationships. So we used the term yesterday a lot, circular financing, and sort of concerns about what happened in the 90s with the dot-com boom, then bust. Is this time different?
Yeah, it's someone sent the meme to me. It's the power cord plugged into itself, powering itself.
Don't do that.
But then
by the
if
way.
you do
not do
exactly,
that.
don't
Not a
do
good
that.
thing.
But the whole question about that picture is, well, where's the power coming from? Then if it's just plugged into itself.
We did a version of this for those who are watching on radio. Like our
there you
whole
go.
thing, like just open AI kind of at the center of the world when it comes to the money flows around AI.
I do. And I know we talked a little bit about this sort of circular vendor financing the last time I was with you guys, but I think you do need to, anytime you bring in the discussion of the tech bubble in the late 90s and then the early 2000s after, I think we always need to keep in mind that no two cycles are the same. No two expansions, no two recessions. The tech recession was so unique in nature where that actual economic recession, the data, was not that bad during the recession. The economy still contracted, but if you look at the drawdown in GDP, it wasn't that bad. I like to think of it as a recession in the stock market because you had epic declines in the NASDAQ 100, the S&P. So I think that there's a risk to it now? Well, yeah. You've got the top 10 stocks in the S&P 500 that are 41% of the index. So by definition and mathematically, you're putting more weight and more sway in those companies if they do move significantly. An example like today with some of the tech stocks that have started to move, as we've gone throughout the session. So that in and of itself is a risk from a concentration standpoint. What we've been telling clients is, if you're not comfortable with that volatility, both to the upside and the downside, then there are ways to distance yourself from that AI epicenter, getting away from things that are power related, getting away from things that are tech related. But that's not necessarily something that anybody can time. So the being invested throughout the tech sector over multiple decades has really paid off, but it comes with a lot of dips in that roller coaster along the way.